Credit risk insurance plays a surprisingly important role in the real economy. It frees up capital, it frees up the ability to trade, and credit risk insurance ultimately enables banks to lend more money to their clients.
My name is Dipesh Patel, Editor-in-Chief at Trade Treasury Payments. Today we're in Lisbon at the IFC's Global Trade Partners meeting and talking about credit risk insurance. I'm delighted to be joined by our expert, Stephanie Parriot, Managing Director and Global Placement Leader for Credit Specialties at Marsh. Stephanie, welcome.
Hi, thank you so much for having me.
Good to have you here. So, quick introduction and elevator pitch. Who are you? Where are you from? And what do you do, Stephanie?
I'm Stephanie Parriot. I've been based in London for the past 19 years, and I'm a managing director on the credit specialties team at Marsh, where we provide insurance solutions for clients.
Brilliant. And well, let's just take it back to the basics. Credit risk insurance, why is it important for real economy trade?
Credit risk insurance plays a surprisingly important role in the real economy. It frees up capital, it frees up the ability to trade, and credit risk insurance ultimately enables banks to lend more money to their clients and enables public agencies and MDBs and DFIs to lend more money to their clients and free up capital.
And innovation is particularly important for credit risk insurance. And actually, one example of that is through Marsh's Fast Track product. What's that all about?
Fast Track is a fast follow facility that Marsh developed in the past 3 years. It allows for up to 10% of additional capacity to be attached to any policy with a lead insurer. The policy that attaches the same terms as the lead insurer, so it leads to a faster placement because the negotiation is all done on the front end with the lead insurer. There's not additional negotiation on pricing or on terms. It's a great development to allow Marsh clients to access an additional 10% of capacity for their policies.
Okay, thank you very much. And I guess looking ahead, and here we are at IFC's Global Trade Partner meeting, what are the biggest misconceptions that trade banks still have about using insurance today?
Sure. I think one of the biggest misconceptions is that everything needs to be a plain vanilla single risk to be sent to the market. Insurers regularly work with Marsh and work with our clients to help develop innovative solutions to meet the client's needs. If it's a tricky country, if it's a tricky transaction, there are things that we can work on in terms of structuring a transaction, in terms of portfolio solutions that we can offer that we're able to work with. So the market is really able to innovate, and insurers are keen to support clients who want to help their clients and mobilize trade.
And the evolution of credit risk insurance is quite interesting because it all started with the commodity traders, right?
Yes, that's correct. Commodity traders were the kind of initial buyers of insurance. They were buying political risk insurance, and then banks started buying political risk insurance in the 1990s to around 2001. Following that, banks needed something more to meet their requirements, so banks worked with the insurance sector to develop a comprehensive non-payment insurance product to meet their needs in order to obtain capital relief and risk mitigation and to help them support their clients.
Interesting. So I guess going back to banks, how do banks ultimately utilize credit risk insurance?
Banks use credit risk insurance to manage their limits, and they also use it to obtain capital relief. When banks tap into the insurance market, they're able to use the insurance ratings, the insurance ratings to substitute for their client ratings, freeing up capital and freeing up limit relief so that they continue to do more business, lend more, and support more of their clients.
Thank you very much. And actually, it's really interesting being here at the IFC Global Trade Partners meeting because Marsh has been working with IFC to unlock $4 billion of supplementary capacity. What does that actually mean? What's that all about?
We're really proud of the relationship that we have with the IFC Financial Institution Group and that we've developed over the past 16 years. Private insurers have a big role to play in helping mobilize capital behind IFC that they wouldn't normally do for frontier markets on their own.
Thank you very much, Stephanie. And actually, Marsh recently launched the Political Risk Report 2026. What were the key findings?
The key findings for the political risk report go into detail. People are much more focused on political risk at the moment. We're in a world where there's heightened regionalization, where previously there was more of a focus on globalization, and the report goes into detail on the kind of risks that clients can consider and need to look at when looking at mobilizing capital.
Thank you very much. Stephanie, what are you most excited about here at the IFC Global Trade Partners meeting?
I'm really excited to be able to speak with some of the frontier markets and banks that we don't normally get to speak to. We speak to a whole range of banks, and it's really great to be here to have an opportunity to speak to some of the frontier banks that we don't normally get the opportunity to speak to. We also have a substantial number of our insurance partners here this week, and as a placement leader, that's particularly of interest to me.
Thank you very much. That was Stephanie Parriot, Managing Director at Marsh. Stephanie, thank you for joining us in Lisbon.
Thank you so much for having me.